Karthik Raj Lakshmanan, who's a Senior VP and Fund Manager of UTI AMC, is joining us to weigh on the markets. Hi, Karthik Raj. Thank you so much for taking the time out and joining us today. Karthik Raj, first up, there were two very bullish brokerage notes that came out yesterday. One was by Morgan Stanley and the other one was by Citi. Now, Morgan Stanley says that the risk-reward sentiment is now in the favor of India. There are a couple of triggers that investors are not really looking at, whether it is the stimulus by the rate cuts by RBI or through the budget that came out this time. Also, the FIIs are now, they are oversold and they might make a comeback. Also, Citi maintains that we might touch 26,000 by the end of December. That's a 13% potential upside. Do you see this as being too ambitious or overly optimistic given the global macros and the looming threat coming in from reciprocal tariffs?
Yeah, we don't really work with a target for a year, but broader picture, if we have to discuss, if we see the macros are clearly good. I mean, whether it's GDP, it is higher than the long-term average of more than 6%. Whether you look at fiscal deficit, that's on a glide path. And as far as current account deficit is concerned, that's under control. The inflation is well under control. So most of the macro parameters are doing well, and there's not much of a concern there. The issue has more been on the market valuations itself. Post-COVID, we've had very stellar earnings growth as far as mid and small caps are concerned, and even in case of large caps. That has come on the back of the operating margins improving. While the revenue growth has broadly been in that 9 to 10% mark, but the operating margins have improved, and that has led to better earnings growth, which has given a fillip to the markets. And to that extent, the markets have been on a roll for the last 4 years, and there was clearly excesses, which we've also been highlighting for some time now. So those valuation excesses partially have been taken out with the corrections that we've seen in the last 4 odd months. But still, we believe that the mid and small caps continue to be in expensive zone, while the large caps may be in the fair zone after this correction.
Well, certainly. Good afternoon, Mr. Lakshmanan. This is Shrishti also joining in. Large cap is the place to be, and that's the consensus call coming in from all the fund managers. But within that, help us understand that where are there, which pockets are you finding the opportunity that is lying in, where the valuations have turned a bit more reasonable. Financials is one thing that's been the consensus call, but apart from that, any other sector that you wish to flag off?
Right. Anyways, you've called out the most consensus one, financials, because this is one sector where the private banks especially have been continuously gaining market share over the last 2.5 decades, and they're likely to continue to do so going forward as well with good return ratios. At this point in time, the asset quality is not so much of a problem. And this is one sector where the valuations, whether you take 5 years or 10 years, the valuations today are probably equal or lower than the average. And to that extent, you have the valuation comfort. So we have a steady growth story, market share gain story, and the valuations attractive. So that still remains one of our key holdings. Other than that, IT is something where we've been overweight for the last 2 years. It's played out well in the last year or so. The thought process there has been that the relative valuations were quite attractive. While the growth is more measured, but the cash flows, the corporate governance, and the cash flows being returned to the shareholders were something which were ticking for us. And to that extent, we've been overweight there. While the valuations no more are as attractive as they were probably a year back, but still most of this a larger theme continue to be positive. And the fact that the outlook for the businesses is improving with the US economy doing well is something which could bode well for the IT sector. So to that extent, we continue to be positive there. Other than that, the consumer durables and retail is one place, especially retail is where we are positive. There is this unorganized to organized story that is playing out. There are quite a few companies in each subsegment. They are doing very well and gaining market share and doing it with good return ratios. So that's one space where we've been positive and we continue to be positive.
Right, Karthik Raj, so you mentioned three sectors. Of course, the financials, you're also constructive on IT, you're overweight on IT, and you mentioned the retail part. I was coming to you about the consumption part, which has been largely ignored till now. So there's some sort of a valuation comfort there. Also, the big fillip that came in post the budget, by the FM. So do you see the consumption pack, especially the consumption pack, as far as the premium end of consumption is concerned, picking up now, whether it is, whether it is hotels, airlines, and so on?
Yeah, so clearly within consumption, we've preferred the discretionary part, and to that extent, maybe retail and durables qualify there. We do have some exposure to airlines as well, and autos as a segment where we've been positive. So these are the segments where we believe the growth is good and the valuations are reasonable. FMCG is one space where the cash flows are good, the visibility is quite good, corporate governance is good, but the issue has been that the growth is lower compared to the valuations that they've had. They've gone through some time correction the last 3-4 years, but still they're not cheap enough. But incrementally, this is one sector where we would want to look at if the valuations correct further. Because most other ingredients are in place. It's just that the valuations for the kind of growth that they offer were not attractive.
But Mr. Lakshmanan, help us with your strategy to play 2025, because a lot has changed since the start of this particular year, and everyone has just become very stock specific. But if one has to look at and start deploying the money right now to take advantage of the correction, what should be the strategy, and should one really go ahead and make the investments right on the top of it, or make a gradual investment and try to make a portfolio out of it?
Right. Like we discussed clearly, large caps still seem in the fair value zone, while mid and small caps, even after the correction, are in the expensive zone. So that is one area that we are saying relatively within the equity portfolio, maybe large cap is a space to look at. And probably, each individual's investing horizon could be very different. So you cannot have a blanket answer, but probably from a near-term perspective, considering the current situation, it's better to kind of have a staggered investment approach. Like I said, I mean, maybe the excesses have been taken out in some pockets. There are quite a few companies which would have come down by 30 to 40% from the peak in the last few months, but still there are pockets of excesses. The clear trajectory that we need to look at is in the last 4 or 5 years, if the earnings growth was high teens to 20% or even higher for mid and small caps, that now comes down to more realistic mid-teens kind of numbers, and there could be even downside risk in the near term to some of that if the operating margins that were going up start to kind of reverse. So we are looking at a single-digit kind of earnings growth in FY25, which is March 25, almost there. But even FY26, as of now, it's mid-teens kind of earnings growth, which could have some downside risk. So yeah, the investors might be better off kind of having reasonable expectations from the asset class compared to what they would have seen in the last 3-4 years. Because the earnings growth trajectory is likely to be more around the early double digits rather than the high teens that we've seen in the past.
All right, Karthik Raj, thank you so much for weighing on the markets, and thank you for taking the time out. But with that, it's time for a quick breather. You don't go anywhere. We'll be right back.